It's actually been a pretty strong year. The one constraining factor is that valuations are high relative to history. I think that's the biggest challenge that investors are grappling with.
We did a pre-conference survey, and about 33% of the clients responded that they were feeling negative about markets.
People are skittish. Markets are pushing towards all-time highs on the equities, so people definitely are looking for protection where they can get it.
I'm so delighted to be joined here by my friends David and Adam. Today we're hosting our inaugural RIA Professional Investment Forum, where we've welcomed over 100 of the top RIA CEOs, CIOs, and investment decision makers into our headquarters. And I'm really delighted to have this time with the two of you around the conference. David, you're the brain trust. It'd be great if you can level set your overall outlook.
So Patty, thanks for inviting me to join this conversation. So the bottom line for calendar 2024 is it's actually been a pretty strong year. It's been a strong year economically, and it's been a strong year with regards to financial markets. U.S. equity markets up 10% year to date, which is great. And the economy has been really strong. And I think that's the first point worth emphasizing. Unemployment rate has been below 4% all year and has been below 4% for more than 2 years. And that has led to strong retail balance sheets, and individual wages are rising because unemployment is low. And that's been a driver of consumer spending, and that's almost 2/3 of the economy. So the backdrop that we see here from economics and global research is pretty strong.
And I note I was with Jan recently, and he's lowered his recession forecast to 15%, which when he was challenged about the risks that he saw in the economy, he said, frankly, the only reason I've even got 15% as a recession risk is just to leave some space for exogenous shocks.
Right. The unconditional probability of recession in any given year is
exactly
about 15%.
1 in 7,
so
right?
So it's pretty low. Shift from the economy to actual financial markets. What we see happening is earnings are growing. And that was really a lesson of the first quarter of 2024. We had earnings that just completed, and earnings were up. Sales were strong. Margins actually expanded more than was anticipated. So that's a good thing.
Yeah.
The one constraining factor is that valuations are high relative to history, both the index as well as individual stocks. So if you think about the backdrop of earnings is strong, earnings are growing around 8% this year. That's a positive tailwind. The economy is going to grow, but valuations are high. And I think that's the biggest challenge that investors are grappling with.
Yeah, well, we did a conference survey of our clients that were coming, and we asked them how they thought about markets for the next year ahead. About 33% of the clients responded that they were feeling negative about markets. 45% said that they were feeling positive about markets, and the balance said that they were pretty neutral. I'm a little intrigued about the 33%, and that same cohort also responded that they were interested in hedging solutions to mitigate, some of the downside risk in markets that they were anticipating. Adam, you're sitting in our derivatives business, and would love your thoughts on how we help clients navigate, potential drawdowns in the market.
Yeah, absolutely. There's a couple ways to go about it. We've seen tremendous growth in the structured notes market over the last 5 years in the U.S., now north of $100 billion a year business. And a lot of these notes provide downside protection embedded in them so that an investor can stay invested in the market, but also have capital protection built into the structure. I think there's no surprise here that is continuing to accelerate as the markets grind higher, because people want the equity exposure on the upside, but building in some hedging on the downside has really, really been something that people have, put into good use.
One of the things that I know that our clients are grappling with is, because of high interest rates and high deposit rates, there is an inertia around the comfort, the delicious comfort of cash yields where they are today. Do you have any, particular advice for clients around putting cash to work?
Well, I think it's really important to think about investment horizon. And so if one's thinking of the next 6 months, or the next year, more likely than not, cash will give you a very strong return. Certainly, it is a visible return relative to other asset classes. However, the expectation is the Fed will begin cutting interest rates for the first time this cycle, sometime here in the second half of the year, and then continue to cut on a measured pace in calendar 2025. And as a result of that, the interest rate environment is likely to move a bit lower. And that is the view of the Economics Research Department. But that still leaves 10-year bond yields probably anchoring around the 4% level. That is actually pretty attractive. Credit is an area, investment grade, high yield credit is a way of enhancing yield relative to sort of federal treasuries. And the idea behind that is the probability of a recession is very low. And so therefore, any kind of corporate credit would be attractive return prospects, in our view, relative to equities. And the issue is, as indicated earlier, that equity prices are high. Valuations are very, very high. So from a yield point of view, maybe not cash, but maybe some other investment products is how I would think about it.
Sure. And on the topic of credit, there's obviously a delta between private credit markets and public credit markets as well. And, over a very long horizon, we've seen private markets generally outperform public markets. I think that's, in a very interesting place for individual investors to think about allocating, more of their capital.
Yeah, I think we're seeing technology really influence how people are able to access some of these products and get comfortable with them. There's better reporting than ever before, and really investors are getting much more comfortable with the idea of private markets. The private for longer story is something that's been resonating really well, and I think generally people are understanding that it doesn't have to go public to be something that you want to be invested in anymore.
I think you got to think about it in two ways. First of all, the idea of private equity getting higher returns is truly a function of the fact that interest rates have been falling for the better part of 30 years. And so that has been a tailwind for higher valuations. That is the one measure of higher returns. On the other hand, as you indicated, that companies are staying private for a longer period of time than has historically been the case. More of the value creation has been inuring to the private investors before the decision to go public.
I think the stat is U.S. tech companies are staying private for, on average, 4 years longer than 20 years ago, and are 6 times larger when they do IPO. And as a result of that, you have this incredible, kind of overwhelming proportion of companies in the United States today that are private relative to public. So that's a pretty, incredible fishing pond for alpha and for returns. Adam, can you just talk a little bit about what you think that RIAs today really need when they're thinking about a valued and trusted relationship, advisor, or service provider?
Yeah, the first is, how do you help me scale my practice? Because these are firms that have grown leaps and bounds, firms that used to manage $8 billion, now manage $80 billion. How can you interact with technology providers and large institutions to help you scale the way that you can work with your clients? That's definitely a top of mind, because the fiduciary model is something that is really attractive. Independent, putting your clients' interests ahead of your own. But these are independent wealth management firms, which means they don't have all the inner workings of some of the largest financial institutions in the country that they can put behind to get their clients. So partnering is a way that they can access them. The other thing that they're really focused on is product access, because a lot of them, want to access new and different types of products as their investor base, as their client base begins to widen out. Some have specialized and serve very specific client bases. Others are moving up or downstream. And so ensuring that they have the right product mix to address those expanding parts of their practice, I think are really important and really crucial.
One of the important considerations for individual clients when they're investing in markets, certainly, we want investment-related alpha, but clients really are also seeking to have tax alpha and to be able to manage tax-efficient portfolios. That really does rise to the top of, what we think that RIAs need to be able to present those capabilities on an investing basis to their clients.
The idea of getting a return basically in line with an index, but giving some benefits on a tax perspective is great, and you can do that both here in the United States, and then we have that on index for Europe and other markets as well. So that's certainly something that I look at with respect to my own money.
David, Adam, thank you guys so much for coming and sitting here and having a chat today about the economy and also the RIA industry and how we're helping guide our clients through choppy, potentially interesting markets and get great investment outcomes. So thank you so much.
It was a pleasure. Thank you.
Thank you.